So chapter 8, we figured out how to calculate NPV, IRR, and how to analyze projects to see whether or not they were worth investing in. Chapter 9 basically shows us how to get the cash flows into those NPV and IRR calculations. How do we calculate those cash flows? That's what chapter 9 is all about. So the important thing is we're going to go back to our definition of free cash flows. It's something we touched on like the first week or two, and we're going to bring that back and look at it again. And then we're also going to figure out how to identify which cash flows to put in and maybe which cash flows not to, because sometimes the situations can get a little murky about all the different things that go into making a project happen. So we're going to talk about those. So some of the key points are we're going to discount cash flows and not accounting profits. We're going to discount incremental cash flows, meaning we try to identify the specific cash flows that are purely due to the project we're looking at. Cash flows that change our normal business. So they're incremental, they add, they change what we already have. We're going to exclude sunk costs. Sunk costs are something like, a decision you already made, money you already spent. Because what we're doing now is we're looking at, at time zero, based on everything you've already got that you cannot change anymore, should you invest your money in this new project? Because worrying about money that you spent a year ago, that's kind of water under the bridge and you can't get it back. And so it's important from our standpoint to in making an accurate decision, you exclude costs that have already been spent and that you cannot get back. We're going to separate the financing and the investment decisions. There's some situations where they'll be together, where you keep them, but from my experience, I never had to do that because I usually worked for larger companies, and different departments would do investing, different departments would do the financing. There are some smaller situations with like private equity or real estate where they do include it, but we'll talk about those. But for our purposes, we're going to keep them excluded. And then we're going to go through an example on how to calculate cash flows. So let's first off look at an example of why we use cash flows and not accounting profits. So here's an example of a project cost $2,000 and expected to last 2 years, producing cash income of $1,500 and $500 respectively, okay? The cost of the project can be depreciated at $1,000 per year for those 2 years. So straight line depreciation, no salvage value. And the required return or discount rate, is 10%. Let's go ahead and compare the NPV of using cash flows versus the NPV of using accounting income. So here are cash flows. And the cash income in years 1 and 2 is $1,500 and $500. That's from the previous example. And now with cash flows, we look at the entire upfront cost, and that was $2,000. And so here are our total cash flows every year when we sum them up. And then when we calculate NPV, we get a negative 223. So because that's a negative NPV, we wouldn't do this project, okay? Let's take a look at calculating NPV using accounting income now. So here's the setup, and where it's different is, notice we're using depreciation to account for our investment, right? And this makes sense from an economic and accounting point of view, because a lot of the point of accounting is to tie the cost of assets to the revenue and profits over time, right? So you get a truer sense of the pure economic income, right? So it's kind of you get a better picture, long range, where your profitability is, assuming, big investments are, their cost is allocated with when those revenues occur. But so the difference here is, right, we don't have initial year zero capital outlay in this. Now we're looking at just depreciation. And so from accounting side, these are the profits we have, the accounting income. And if we were to go ahead and calculate the NPV, we get a slightly positive $41. So that's quite a bit different answer than we got using cash flows. And from an accounting from a financial standpoint, we use cash flows. You can think of the old phrase, cash is king. And the reason is, we're using time value of money. And for time value of money to work, it has to be cash in your pocket that you can use to invest, get interest on. And from a accounting income standpoint with depreciation, that's not money you can invest. So it's there's nothing wrong with it from an economic point of view and trying to model the profitability economically of a company over time. But from an investment cash flow standpoint, money in your pocket that you can invest or take as profits, it really doesn't work for us, and it doesn't work from a time value of money standpoint. Okay, so for us, we use cash flows. So what are the cash flows we're going to use? Well, you're going to ignore sunk costs. Sunk costs are costs that have already been incurred and they cannot be changed. So it's money's already been spent, and it should not have an effect on your decision you're making today. On today, it's brand new money that you haven't spent yet, and so it's a new decision. So forget sunk costs. That's the bottom line. Include all indirect side effects. So you may have an idea for a project, but sometimes companies have entire product lines, and a new product could affect the sales of other products in the company. So that's something that should be taken into account. Like you might come up with, I don't know, maybe an online app for customers, and that app will help the company in general sell its other products. So those side effects of how it helps the rest of the company will come into play. Include opportunity costs. So by that I mean opportunities that you're giving up by doing this project. So if there are alternatives to this project, you should think about presenting them as alternatives. I'll give you an example. Let's say you own a piece of land, and the project you're proposing that you're going to do the NPV analysis of is to build a new building on it. Okay? But there is another potential solution you could do, that is to sell the land. So the way to handle these opportunity costs is to have different scenarios, different options, right? So one option is build a building on the land. Option number 2 is to sell the land and let someone else build a building. So take that. So that's a good way to take things into account. Let me give you an example. I worked on a project for air conditioning systems for public transportation buses in Europe, and so there were 2 options I looked at. One was to buy a company that already manufactured air conditioning systems that would, the bus manufacturers were put into their buses. But the other option was to in-house design a brand new system ourselves and then go out and have to sell that to the bus manufacturers over in Europe. So that was taking into account all the different opportunities we had. And so don't forget to do that. One way to look at incremental cash flows is they're basically equal to the cash flows with the project. So like total cash flows, what's the cash flows of the company with the project, and what are the cash flows for the company without the project? And the difference between those two are the cash flows that are just because of this project, that are because of this project. And those are incremental cash flows that we want to capture. Include salvage value and shutdown costs. If you intend to run a business for a certain number of years, you might be able to sell the equipment at the end. A lot of computer equipment though is pretty worthless right now. That's old stuff. I remember doing some work for Albertsons, and they pretty much run their computers. I think they depreciate over like 4 or 5 years, and basically they have zero salvage value. And you're talking millions of dollars of computer equipment. So and sometimes salvage value will be nothing, especially with something maybe high tech. But if you're buying trucks or something like that, trucks would probably have some salvage value if you plan to run those trucks, because you're going to start some maybe Amazon delivery business and run them for 4 years and then sell the trucks at the end. Those trucks would have salvage value. Also take into account shutdown costs. Let's say you're gonna run an outdoor beer garden. At the end, and you only get the lease for like 3 or 4 months. At the end, you should include some costs in your NPV analysis on cleaning up the place, right? Because the person who's renting the property probably wants to make sure it is cleaned up at the end. Don't forget about working capital. Working capital is like when you have to put money up front for inventory. It's accounts receivable, because customers don't pay you right away sometimes. If you got credit card, that's great, because then you don't have to worry about that. You're using Square or something like that. But if you're selling to other businesses, not all businesses pay with a credit card. Sometimes they pay on account with 30, 60 days payment plan. Then you have to think about that. Beware of allocated overhead costs. This is more in a larger business where, from a managerial accounting point of view, overheads like, corporate headquarters, landscaping at the corporate headquarters, the electricity bill for the entire 8 headquarters and distribution centers, manufacturing, all that, where it's combined and there's only one bill. They kind of have to take some of these costs and they want to spread it across, the different product lines, so they understand how profitable things really are. But we just have to be careful with that, because you might be coming up with a product that really is not using some of those overheads, but there's a default where everything gets some overheads, because overheads are like spread on products like peanut butter on bread. You just spread these costs over everything and everybody takes their piece. But if you're looking at a really good project and NPV is marginal, one avenue is to argue whether or not those overhead allocations really are fair for this product you're looking at. And don't forget that investment decisions are separated from financing decisions. And for us, even though we're not going to put in all the financing costs like interest and stuff like that, just understand that financing is indirectly built into our NPV calculation, and it's built in through the cost of capital. If the company has a hard time generating capital, getting money from investors, and let's say they have to pay really high interest rates on their debt, guess what? The discount rate's going to be really high then, because that's just it's related to the company and its riskiness and its financing. So if you're not sure if something's an incremental cash flow, ask yourself, would the cash flow still exist if the project does not exist? If it's yes, then don't include it in your analysis because it's there no matter what. But if it's no, that the cash flow would not exist without this project, then you should include it in your analysis. All right, we're going to take a quiz now. Everybody sharpen your pencils. I want to ask you on each of these, we're going to go through like 8 or 9 of them. Is it an incremental cash flow? Should we include it in our project cash flows? That's the question. So number 1, the market value of the site and existing buildings. And so let me just backtrack. Sorry. The project is that we own an old factory, okay? You can sell it or demolish it and build a new one. So you can sell the old factory real estate or you can build a brand new factory. Which cost should be included in your MPV analysis? So number 1, the market value of the site and existing buildings. Should we include that? Just give me a yes or no in the chat if you can. Yeah, that's a big yes. Everybody's saying yes. Yeah, because one of our options is to sell the land and get rid of it, right? So that's definitely something we have to take into account. It's an opportunity cost. All right, number 2, demolition costs and site clearance costs. Definitely, right? I mean, that's definitely part of the project. We haven't spent it yet. Oh, incidentally, I don't know if you guys seen it. You should look at the old Google Warren Hall demolition video or something like that. Warren Hall implosion. This was before you guys were here, but we used to have a really big, like a 10 or 12 story concrete building called Warren Hall. It's over by where the library, the police office is. And it basically wasn't earthquake proof, and it was going to cost too much to retrofit it. And so it stood around empty for a number of years. One reason was because there's some peregrine falcons that were nesting on it, so they couldn't take the building down. But then after the falcons were gone, they imploded the building. It was pretty big deal demolition wise. So check that out. Warren Hall, Cowsted East Bay or something. You should find that video. The cost of a new access road put in last year. Yeah, that's a big no. That is sunk cost. Yeah, that's a no. Sunk cost. It was put in last year. Don't worry about it anymore. Number 4, lost earnings on other products due to time spent on this new project, this new facility. Yeah, this is one of those indirect side effects that we were talking about. You have to take that into account. Like, what if for some reason you've got your salespeople all busy, working on this project, and they're not out calling on customers? Number 5, a proportion of the cost of leasing the president's jet plane. Now, this is going to be kind of like inside corporate overhead, so you won't see this specific cost, right? And remember, overheads are spread over everything in the company like peanut butter on bread. And so I think you could argue that, maybe the cost of leasing the jet plane doesn't really have anything to do with this real estate project, right? Because the cost of that plane is going to happen no matter whether this project happens or not. So it might be unfair to kind of put that cost on this project. But so I would say the answer is no. But at the end of the day, if it's the president's company and he says or she says, put it in the analysis, then you put it in the analysis. It's as simple as that. But the answer, would be no, ideally. Number 6, future depreciation of the new plant. Now, I'm going to put up number 7 at the same time here. Reduction in future tax bill from future depreciation. So it's kind of a yes-no answer here. Now, the depreciation doesn't directly go into cash flows, right? It's more that it indirectly has an effect on taxes. And that's how depreciation goes into our are cash flows. So the answer to number 6 could be yes or no, depending on how you interpret it. But certainly the answer for number 7 would be yes. Initial investment in inventories of raw materials for number 8. Think of that as working capital. Yeah, can I get a big yes? Yep. Excellent. All right, number 9. Money already spent on engineering design of the new plant. Yeah, the key is it's a sunk cost, right? So the answer is no. This is going to get tough, though. Like, what if you do the NPV analysis and it's like really marginal, right? It's not that high. And then someone stands up and says, hey, you didn't include the engineering design. If you include the engineering design, it's already negative NPV. And your answer to that is that's a sunk cost. We've already spent that. It has no decision based on where we go from today. And based on today, we only have to invest a certain amount, and that amount does give us a positive NPV. Let's talk about inflation a little. So that's it. We're incremental cash flows. The important thing with inflation is I think for 99.9% of your applications, you're not going to have to worry about inflation because companies really just forecast what the dollars that you and I see using the interest rates that you and I see every day. You know, they forecast what's the price of the product going to be this year? What's the price going to be next year? Well, so they forecast in price increases. And these are called nominal dollars and nominal interest rates, the interest rates you and I see every day. The other version is when we take out inflation. And I think it gets a little bit confusing, but there are some economic analyses where they like to remove the effects of inflation. But from the standpoint of doing financial analysis like this for investment projects, I've never really seen it. So the key is just to be consistent. If you find yourself in some situation where you're asked to use real dollars, then you have to use real interest rates as well. So that's what I mean by being consistent, is that if you use nominal interest rates, use nominal dollars. If you use real interest rates, use real dollars. And everything we do is usually nominal. It's good to know, though, that as long as you do this correctly, you get the same results either way. Okay, we separate the investment and the financing decision. And so we ignore how the project is financed, especially with a big company. Because big companies, you know, they have a separate treasury group whose responsibility is to make sure that the company has enough cash on hand to pay the bills, to buy pieces of equipment for capital investments. And those people do not really get involved in making investment decisions, like should we or should we not invest in a certain project. Now, what they'll do is they'll get like a cash budget, and based on that cash budget, they'll know, oh, we have to raise more money next year to help pay for this project. But they don't get involved in the decision itself, whether or not to invest in the project. That being said, there are some not common situations where financing is integral to a project. And without the financing, there is no project. In those situations, we will include things like financing costs, interest, and things like that in our analysis. The only times I've seen that happen is with real estate projects where, you know, financing is tied to the real estate itself. And the other instance is in kind of mergers and acquisitions where private equity hedge funds are basically looking for, you know, junk bonds, high interest financing to do these leverage buyouts to buy up companies. And in those cases, the financing is integrated with the project, and the investors really want to know what their return on equity will be. That's what their whole raison d'etre is. And so, but if you're working for any normal company, maybe normal is not the right word, but any other type of company, it's a separate decision. And anything that has related to finance, it's all kind of already baked into the discount rate. All right, this is the last slide we're going to do today. This is just a reminder. This was the equation for free cash flows. We covered this way back in like week 1 or 2. This is how we're going to calculate it. It's earnings before interest and taxes. Sometimes that's the same as operating income. And then we subtract taxes from it. But then we add back the depreciation because depreciation is a non-cash expense. And the only reason we allow it to be deducted to get EBIT is so then we can calculate taxes. Then we subtract the increase in working capital and finally any capital expenditures. So that's the fundamental equation we're going to use when we go ahead and do different project analyses. So that is it for today.